Hi, welcome to Retiring Well. Folks, we got a great show lined up for you today. We're going to be talking about elder abuse, right? Or what we call elder fraud, right? What does that look like? What are some warning signs we can look out for? We're going to talk about systematic risk, or beta, as it has to do with your portfolio as we analyze it. What about the power of indexing? A lot of times these insurance products will have these indexing strategies. What do those look like? How do they work? And then finally, we're going to end with what is risk variance, right? You know, sometimes we understand risk, but how can variance play a role in with that, and why do we want to know about it? So folks, stay tuned. We have a lot to show you.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
Hi, listen, in this segment I want to talk to you about what we call elder abuse, or what we call fraud, okay? Listen, this is a growing thing. You know, you've got the elderly that are holding a good vast majority of the assets out there, and they're easy prey, especially as you get older. So you want to be very careful of a lot of these what I call schemes or scams, you know, that could arise. You know, but what are some of the warning signs you might want to look at when this is happening? If you have a family member, maybe a parent, and you have some concerns, maybe something like this is going on, what's some things you can look for? Well, one might be incomplete information. You know, do the tax documents back up some of the transactions or things that happened that you understood were happening? All right, very important that there's proper documentation backing up a lot of this stuff. You know, so if that's incomplete or missing, be curious about that. You know, check into that. How about you know, a significant decline in what we would call interest and dividends from one year to the next? If that's significantly a drop, where did those investments go, right? Again, be curious. Let's ask some questions. Are there an unusual amount of what we call now promissory notes or gifts to, you know, family members or friends, or maybe not? You know, what's that all about? Was there good purpose behind it? Did the person or the senior intend to do that? What would you think about what's called exotic forms of investments? Okay, these would be investments that the senior doesn't even know what they did, right? If you're asking that question from a parent or something, you know, hey, why did you do, or why you invested this way, or how are you invested, and they can't answer that question. Again, let's be curious. Let's get behind that and see if there's anything there that we should be looking at. You know, I had one time a client had moved, you know, a vast sum of money out of the investment I had them in. Come to find out, you know, somebody had them investing in these ATM machines in California. There wasn't anything I could do to stop it. The person was convinced that this is where they should go. Ended up losing a lot of money. I dare say I felt like there was some abuse there, fraud, because they were taking much more risk on than they should have. How about fees? You know, what about the broker's discretion? How much discretion has the parent given that person? You know, you want to check on that. Are they doing things in such a way that it's in their best interest and not the client's? Do they have an investment advisor? Is what that investment advisor recommending suitable? You want to look for that. How about unusual capital gains in a portfolio? You know, things being sold off, and why? Again, let's be curious. How about exchanging one instrument for another financial instrument? What was the purpose? Was it necessary? What they moved into better than what they had before? Folks, there's a lot of things, there's a lot of warning signs, but you know, it's one thing if we want to watch after our seniors, our elders, let's be kind of a safeguard for them there. Let's be curious when we see things that might raise some red flags that we might be wanting to check into. If you ever suspect that there's elder abuse, then you want to call your local FBI and let them be aware of it. So hopefully you found this valuable. Just some things you might want to look at. Thanks.
Welcome back here to Retiring Well for another great week of teaching you how to retire well. And this week, Larry got right into the show and talking about maybe a very serious topic here that we haven't talked about in a while, but elder abuse or financial abuse. And not a fun thing to talk about, but guys, this is something that we as fiduciary financial advisors have to be looking for quite often. But you out there as well, watching for yourself and maybe some loved ones as well.
Yeah, it's so important to make sure that you're trusting your financial advisor. I think one of the best and yet simplest definitions of trust that I've ever come across is that trust equals consistency over time. And you know, one thing we as advisors don't really have on our side when we first meet with you is that time. So what you're going to find when you come in and sit down with us is we're a no pressure type of firm. I mean, I think I can speak for all of us and say that we're not going to push anything on you. We're just going to get to know you in those first meetings.
For sure. You know, I work out of the Cadillac office, and I love the opportunity to sit down and teach and to help you understand the situations you're in. Going back to some of the elder fraud that happens, you know, I think what I've researched, it pretty much starts with the phone call, and these, you know, bad actors are trying to get an emotional attachment, and then that creates and opens up a lot of doors. And so just being very careful of that. The mailers that they send out, you know, just talk to someone that is a loved one, and don't just hold all this information or have to make all those decisions yourself, especially if you're concerned. If there's that high pressure situation that Nick is talking about, you're just not going to get that with us. We're here to help, and we're here to teach, and that's what makes our jobs really fun.
Absolutely, guys. You know, one of the things here as you're doing this, one thing for all of you out there is to watch out for each other. Watch out for your loved ones, your family. You know, if there's somebody's calling you up, or in today's world of technology is making you feel pressure, there's something that has to act right away, maybe that should be raising a little red flag, and be cautious of that. Because most things out there, they're not going to run away this instant. You know, have a chance, I'll call you back, let me do my own research, that sort of stuff, to try to get that sale over the phone or an email. So be very cautious with that. Stay tuned, because we're going to be getting into more topics here on Retiring Well that are going to help you for your planning.
Centennial Wealth Advisory is a proud sponsor of the Traverse City St. Francis Gladiators football team.
Will your money last as long as you do? Check out our free instant download on sen-wealth.com on the key financial challenges that can make or break your income plan in retirement. To receive this instant download, simply visit sen-wealth.com, scroll down, and click Download Now to receive your copy of Will Your Money Last as Long as You Do? Simply visit sen-wealth.com.
Have you ever heard that saying, all ships rise and fall with the tide? Well, in our industry, this is what we call systematic risk, or beta, which I'm going to explain here in just a minute. So here's the idea. Let's say that I'm in an index fund that's tied to the S&P 500. Okay, this is an index fund that basically owns the S&P 500. Now, if I'm comparing that with the benchmark itself, or the index S&P 500, you would expect that index fund is going to go just like with the market, right? So if you see the S&P 500 rise, 2-3%, you're going to see that index fund rise 2-3%. For the most part, right? Think of a mutual fund that's made up of large company stocks. If a large portion of those stocks are the S&P 500, you would also believe that if the S&P 500 went up 2-3%, that most likely that mutual fund invested in the same would rise about the same. This is what we call systematic risk. The idea that that your portfolio is going to be pretty much going with the market. Now, that's a good thing if the market's cooperating. If I see the market do well, and I'm watching that benchmark, I know my portfolio did well, right? But what if it's the opposite? What if I'm watching, the market going down? I could probably expect my portfolio to be going down right along with it. Now, the ideal thing would be to have it go up with the market, but not have it go down with the market, right? Now, we have the ability to get behind any portfolio and actually find out what its beta is, okay? B-E-T-A. What it is you take a beta of 1.0, and that means that portfolio is basically going right with the market. If the market goes up 2-3%, you can pretty much expect that portfolio to go up by 2-3%. If it's down by 2-3%, you should expect it to be down by 2-3%. Now, a beta score of less than 1, okay, maybe you say it's 0.8, means that it's going to be less riskier than the market. So market's up 2-3%, yours should only be up 1-2, all right, and vice versa on the downside. Now, a beta score of 1.0 or more means that the portfolio is more riskier than the market. So it's going to possibly do even better than market, but probably do even worse than the market. So knowing the score is very important, because if you have a well-diversified portfolio and at the end of the day it has a beta score of 1 and it's pretty much just tracking the market, well, if that's what you want it to do, that's a good thing. But if it's on the downside, if it's not what you want to do, maybe that's a bad thing. So I encourage you, if you're somebody that doesn't know that score, doesn't know how your portfolio would operate as it's compared to the market, then give us a call. We'll gladly analyze that portfolio and tell you what your beta score is.
Hi, my name is Jack Klunder, and I am a financial advisor with Centennial Wealth Advisory. I work out of our Cadillac office, and we specialize in retirement planning. We take a very holistic approach. We start with investments and see how you're situated there. We do wealth management. We do income planning. We do tax planning, any kind of healthcare issues or needs that you might have for insurance. And then we talk about what your legacy plan might be. So if you are nearing or in retirement and you have questions that you want to go over, please give the number on the screen a call, and we can have and set up a free, no obligation consultation.
I want to talk to you about what's called the power of indexing. Now, folks, there's a lot of these insurance products out there that will have these indexing strategies, and I think it's important to just kind of understand how they work. First of all, on this axis here, I have $90,000, $100,000, $110,000, $120,000, $130,000. And then along this axis, I've got 5 years, 1, 2, 3, 4, and 5 years. Now, in each and every one of those years, the stock market, I'll pick, let's say the S&P 500 index, is going to make 10% in year 1. It's going to make 20% in year 2. It's going to lose 25% in year 3. It's going to make 5% in year 4. And then it's going to make 20% in year 5. So just one down year. Now, if you look at that, if you average it out in that 5-year period, S&P 500 basically averaged about 6%. Now, I'm going to take an investment that starts off at $100,000 right here in this white line. And in the first year, it's going to be tied to the S&P 500 totally. So that investment went up 10%, so it went from 100 to 110,000. And the next year it grew 20%, so it from 110 went up to 132,000. But then had a 25% loss, so it went from 132 down to 99,000. Now at this point, after 3 years, they're just down 1,000, right? In the 4th year, it makes 5%, so they get up to 104,000. And then in the 5th year, it makes 20%, so they get all the way up to 125,000. Now, if you look at the average for that investment, 25,000 over 5 years, basically it averaged 5%. And it didn't average what this one did, the S&P did in that time, because it had that one down year, right? Now, take an index account. Okay, this is one that says you're going to give you, none of the down. So if the S&P 500 is down, you make 0. But if the S&P 500 is up, they're going to give you 50% of the up. Again, 50% of the up in the S&P 500, none of the down. So what happens? That same investment of $100,000 in the first year made half of this 10%, so it went up to basically $105,000. Okay. In the second year, it made 20%, so it went up to $115,000. But in the third year, because the market was down, it made 0, so it stayed at $115,000. All right. In the fourth year, it makes 5%. So it goes up to $118,000, and then in the fifth year, it makes 20%, got all the way up to $130,000. Now, they only give you half the up and none of the down, but in that period of time, averaged 6%, and there was no risk of loss whatsoever. So folks, sometimes these accounts can be appropriate, but I just want to kind of illustrate how they work. So maybe if you have one of them, you can make a better decision regarding it.
Wow, 2 really powerful segments there that Larry just did with a lot of information. Hopefully you caught all that there with systematic risk and the power of indexing. And 2 really critical things when you're talking about investing. One of the investing is, remember, that one piece of the overall plan. Jack, I know down in the Cadillac office, you work with retirees and pre-retirees all the time on helping them build a plan and even trying to mitigate a lot of this risk in various different ways.
Yeah, the first thing I like to look at is, what is my risk? That's what I love diving into, all the features behind the portfolio and how they're currently structured, because once I can understand the risk, we can start talking through ways to mitigate that risk. Maybe using a personal story, I love water skiing, and I love teaching my kids to water ski. And they've been skiing from a very, very young age, before they could walk. And I think if somebody was bystanding on the shore and watching this, they might say, that's a lot of risk. But I spent a lifetime falling on the water. I spent a lifetime mitigating that risk. And so, first to identify the risk and then to have a plan about the risk can really address a lot of the systematic risk that your portfolio might be currently open to that you're not even aware of. And so just having those tools, being able to help you first analyze and then maybe make a plan from is a powerful tool and option that we have.
Absolutely, and there's so many different products out there where you can take on, or you can have a little bit of less risk, but still participate in the market. That's kind of the power of those indexing, right? So we have various products out there where you get certain participation in the market, still getting some of that possible interest, but you're mitigating those risk tolerance. So.
Absolutely. At the end of the day, what Jack and Nick are talking about here, and all of us advisors, is having that financial plan and having that plan to fall back on. And why are you investing in the things you are? So often, guys, we see people come into the office and they have a 401k statement or IRA statement, and there's a plethora of different things on there, and they don't understand why they have it. What are those doing for? How are they producing income? How are they protecting you? How are they gaining stuff? All of those things are pieces to look at. So if you haven't had an analysis done in a while, give us a call at the number on the screen. We'd love to sit down with you at any of our offices and walk through what that may be and how it best fits you. Stay tuned, because coming up next, we're going to have a blast from the past with Michael Reese talking about risk variance.
Your grandchildren are precious to you. They are your life. This is your time to have that special relationship. Taking care of yourself is taking care of them. Centennial Wealth Advisory is offering a free, no-obligation retirement review to make sure you don't run out of money during your retirement. Centennial Wealth Advisory. Your best is yet to come.
Centennial Wealth Advisory is a proud sponsor of the Traverse City St. Francis Gladiators football team.
This week in CFP Talk, we are looking at risk, and specifically we're looking at volatility, because here is something nobody talks to you about. Yeah, if you've ever watched or if you ever listened to Paul Harvey, remember what did he used to say? And now for the rest of the story. Well, that's what we're going to talk about here today, is the rest of the story, because at the end of the day, the financial industry, they're always trying to tell you, here, we're going to get you better return. Better return, better return, better return. But they don't talk about how they're getting that better return, and guess what? It matters. In fact, it matters a lot, as we're about to find out. So here we go. We're going to imagine two portfolios. We've got $1 million in this portfolio and $1 million in this portfolio. And so we're going to pretend, you win the lottery, you have a rich uncle die, something happens, you inherit $2 million. No, let's make it more fun. You inherit $3 million and you go blow and spend $1 million of it on whatever you want, and then the $2 million left over you invest. There, that's more fun. So we have $2 million here. And let's imagine the first $1 million you put in a more aggressive portfolio, and the other $1 million you put in a little bit more conservative portfolio. Let's take a look and see what happens. We're going to pretend in year number 1 that the aggressive portfolio is up 60%. How cool is that, right? 60%. Man, that's awesome. And then the other one, it's not going to do quite as well. It's only going to earn 30%, but guess what? I don't know about you, but I'm still pretty happy with 30. But of course, we all know what goes up must come down. So in year 2, we'll assume the aggressive portfolio, it's down 40. This one will be down 10. But notice what's going on. Let's do some math. Plus 60 minus 40. That means that we had a 20% overall return. We did this for 2 years, so that's 10% a year. Pretty good. What about over here? Plus 30 minus 10. Same 20% total return, but, and the same average return. Now notice the difference here though, because over here we have a range, a variance from plus 60 to minus 40. That is a variance of 100%. In other words, plus 60 to minus 40, that's a wide range. Here, our variance, or our range, plus 30 minus 10, that's 40%. Okay, you with me? Same return, same average return, but the range or the variance is different. That's the only difference. Now, let's see how that affects how much money you have. We'll start over here. You start with $1 million. You earn 30%. Well, what's 30% of $1 million? It's $300K. So at the end of 1 year, you started with $1 million, you have $1.3 million after 1 year. Not bad. Next year you lose 10%. What's 10% of 1.3 million? It's 130,000, right, minus. So we started with $1 million. We averaged 10% a year. We ended at 1.17 million. I'm good with that. All right, let's look at this one over here. Start with $1 million, you're up 60. So, that's $600K. After 1 year, you're at $1.6 million, and you are a certifiable genius at this point, right? I mean, you've got Wall Street knocking on your door saying, how'd you do that? But the next year, you lose 40. Now, pay attention. 40% of 1.6 million is minus $640,000. You started with $1 million, you averaged 10% a year, and you lost 40 grand. Now in the financial industry, we have a phrase for that. You ready for this? You know what that's called? Oops. Yeah, that's what we call it. Oops. Didn't mean to do that. Now what's terrible, this is the worst, this is what people don't get. This is what they don't tell you. I know of mutual funds that have, for a 6-year period, have averaged 16% a year, and they still lost money. Because bad years, I'll tell you why, it's right here. Bad years kill you. One bad year is all it takes. It kills you. These same funds, 6-year track record, 16% a year. Morningstar gave them 4% or 4-star ratings. 4-star ratings, They lost money over 6 years, showing a positive rate of return. Why do I talk about this? Here's the worst news of all. This is the worst news. We have hundreds of people, just like you, good people just like you. You come visit with us. We run an analysis of your portfolio. You know what? We find about 85% of the time, your portfolio has a variance that looks more like this than this. In other words, odds are high you're taking on way more risk than you think you're taking. You're closer to this portfolio than that portfolio. That's not good. That's going to get you into trouble. Next time markets go south, you're going to get into trouble. Pick up the phone. Give us a call. Come visit with us. Let's find out where you are. If you have questions about this or anything else in this show, please call, visit, or visit the website.
Hey, I hope you enjoyed that little segment, a little blast from the past from Michael Reese, where he could teach you about some pretty interesting numbers, risk variance, and why and how that might apply to your situation. If you're wondering about your current situation, you want to come sit down and have us do some more chalk talk on the board and go through that with you, we'd love to do that. You know, one of the things that I think is important to look at is the risk of your portfolio and what are you doing about that risk.
No, that's a great point, Jack. You know, when I think of all these sometimes financial jargon that we talk about there, we lose sometimes the real world feeling of that. You know, one of the real world things that happened to some clients of ours before they come to us with risk variance is they were working along and didn't touch their 401k or really didn't pay attention to their 401k for years. They were in that growth and accumulation phase of their life and just plugging away, putting money in, and they were taking a lot of risk, and they had a high risk variance. And what happened is this couple was preparing for their retirement. They were in the automotive industry, and they worked so hard to get there, and they were literally filling out their retirement paperwork, and the market crashed on them. And what happened is because of this high risk they were taking, they lost a great deal of assets during that time. What did that mean to them? Time. They literally had to resign from the retirement, take their retirement papers back, and work 5 more years. You know, and so when you talk to them about risk variance, it's not numbers, it's time. They literally lost 5 years of their retirement time. That was 5 years less of grandkids, 5 years left of travel. Folks, if you're not paying attention to this and you don't understand what that is, it's really critical, especially as you're transitioning from that growth and accumulation phase to that preservation of wealth and income phase.
Yeah, I mean, I see that so much in the Gaylor and Petoskey office where people really don't know how much risk they're taking. And so what is really neat is that we can get behind all those investments that you have and show you exactly how much you could potentially lose in a year. And for a lot of clients, it's really shocking.
Absolutely. You know, this is so important, folks. If you're nearing retirement or early in retirement, give us a call to the number on the screen. All of us here would love to sit down, free, no obligations visit, no pressure. Let's just sit down, review what you have. Let's review that retirement plan that you have, or develop one if you haven't had one. So hopefully you enjoyed the show this week and took some great notes and some good takeaways. See you again next week on Retiring Well.